I'm breaking down the most valuable book in investing from the guy that taught Warren Buffett how to invest to reveal 3 stock picking strategies that really work. By the end of this video, you'll have those 3 ways to pick stocks from the intelligent investor, why they work, and how to put them in action. We're talking how to pick stocks today on Let's Talk Money. Beat debt, make money, make your money work for you, creating the financial future you deserve. Let's Talk Money. Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a little part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Today's video is going to be a great one, a review of one of the best investing books ever written. In fact, Warren Buffett learned from this author and said exactly that this is by far the best book on investing ever written. We're talking about The Intelligent Investor by Benjamin Graham. Now, Graham is credited as the father of value investing using fundamental analysis to value stocks. He also pushed for the creation of a chartered financial analyst designation, of which I'm a charter holder. Now, Warren Buffett picked up the book in 1949 and then studied under Graham at Columbia Business School in 1951. The ideas in this book have guided his investing strategy ever since and helped him nearly double the return on the stock market with that Berkshire portfolio. So these 3 stock picking strategies I'll be talking about come straight from the book. I've used these strategies working for wealth managers and as an equity analyst. I've also used them to pick stocks for my own portfolio, and I'm going to show you exactly how I do that. Before we get to those 3 strategies though, I want to share 2 tests Graham points out for any stock picking strategy. Now, these are 2 questions you need to ask for any strategy you use. First, does the strategy make sense rationally? There should be some fundamental reason why the investment is going to succeed, usually some advantage the company has against its competitors. Second here is the strategy different from any or not overly used by the rest of the market. If everyone piles into the same stocks by using a particular strategy, then the price of that stock is going to be bid up and eat away at any potential profit. So we'll be asking each of these questions with each of the 3 strategies we look at and then walking you through how to get started. Our first investing strategy here is contrarian in large unpopular companies. Now, a contrarian investor is someone betting against the prevailing direction of the market or in a particular stock. If a stock is being beaten down and most people are pessimistic on the outlook, the contrarian might find a reason to be bullish and buy the shares. Now, this doesn't mean that a contrarian investor just jumps into any stock that other investors hate. You still have to have that fundamental, rational reason for investing. That list of unloved stocks just gives you a narrower list from which to start for looking for those good stocks to buy. Now, the reason Graham suggests sticking with those large companies here is because those are the ones with the financial flexibility to survive maybe a year or more of that poor investor sentiment. You can invest in these companies and trust that good assets and a strong brand are going to help it rebound eventually. When the company does turn around, not only will profits push those shares higher, but investors are going to rush back into the stock and drive that price even higher still. Now, Graham doesn't offer too many clear signals for when to start looking at a stock as a contrarian investor. He talks about following the price to earnings ratio, but doesn't go into specifics. So the investing website Morningstar provides some really helpful information on that current price to earnings, as well as a 5-year average PE for each stock for comparison. Go to a stock listing, we'll use Microsoft here, and then click on that valuation tab for comparisons on different valuation measures. You'll find here the current price to earnings ratio as well as that 5-year average, and then the average for stocks in the company's index. Now, there is a warning here when it comes to playing the contrarian as a stock picking strategy. Some of the largest and strongest companies have made fools of investors. BlackBerry Limited, formerly Research in Motion, once ruled as the undisputed leader in mobile phones. Shares reached an adjusted $138 each in 2008 before starting a painful descent as Apple chipped away at that market control. Contrarian investors were there all the way, saying BlackBerry could reinvent itself. More than a decade later, the stock is down over 90% and has changed its name and is unlikely to ever reach those record highs. So there are 2 rules you can use to play the contrarian investor and be successful. First is just to go back to that reason for investing in the company through careful analysis of the business. This means looking at the financials and at the competitive position of the company. Second is to never chase a stock too far. Buy once and then have a couple of predetermined prices that you'll buy more if the price falls further, but never hold more than 5% of your portfolio in a single stock. It's just too easy to keep buying in, hoping that the stock is going to eventually rebound, and pretty soon you've got half of your wealth in this company. Now, Graham's next stock picking strategy is to look for bargain stocks. Now, these are stocks trading at prices well under some measure of fair value. He's again light on the details, but does talk about using two ways to find a company's true value. First is called fundamental analysis, and this is really the backbone of investing, looking at those financial statements and the qualitative side of the company to come to a fair value. He also suggests M&A analysis, or mergers and acquisitions, and this is where a lot of my experience is working with those venture capital firms. In mergers and acquisitions analysis, you're looking at what other companies are paying for similar companies to your target. For example, here's part of an analysis I did for investors in 2016 for startup investors on an investment in Pinterest. Even though Pinterest was a private company, I could look at those public acquisitions to value the social media site. So I took 7 social media acquisitions and found price multiples on revenue and users. Then I could use the averages against Pinterest numbers to find that fair value for the company. Now, Graham doesn't say at what point you should buy into a stock once you've estimated that fair value. He does say that it's hard to go wrong buying something for a 50% discount to fair value, and yeah, I'd have to agree there, but it's not often you're going to find shares for half off what they should be worth. He does point out one good signal though, and it's extremely rare. This is when a company's stock trades for less than its current assets minus the liabilities, something often referred to as the net current asset value. For this, we go to the balance sheet for any publicly traded company. The current assets include cash, inventory, and sales booked, but not collected on. Now, these are all fairly liquid and assured, so it's like money in the bank for the company. Liabilities are the sum of the company's debts and other obligations, like taxes and wages payable. Now, in this example, we see that Clear One has current assets of $26 million and total liabilities of only $6 million for a net current asset value of $20 million. Now, this is already a good sign that a company's current assets are more than its liabilities. But then we look at the market capitalization of the shares, or how much the company is valued at in the market. Now, here we see that the company is trading for $11.6 million, so indeed less than that net current asset value. Again, this net current asset value measure shouldn't be your only reason to buy a stock. It's just another qualifier you can use when finding a company that has a good business model, a competitive advantage over peers, and some solid financials. So Graham's last stock picking strategy we'll look at is called special situations. Now, this is going to include companies that might be acquisition targets, bonds of bankrupt companies, monopoly breakups like those in the utilities and telecom space, and then companies hit with lawsuits. There are an army of analysts that focus specifically on one of these 4 stock picking strategies. All 4 can help you find some great investments, but there is a lot of research involved. For acquisition targets, you need to be able to see the fit between 2 companies and whether a deal can even happen against the potential for regulatory oversight. Often when one deal is announced, all the stocks in the industry are going to move higher on that idea, so it's going to start a trend in M&A activity. Now, I'd say avoid bonds of bankrupt companies. This is a whole different universe of investing. You run the risk that the company isn't able to restructure and pays little or nothing to bondholders. Now, monopoly breakups are rare these days, as most sectors have been privatized and deregulated. You could look for companies spinning off different segments into new shares, but this means researching the benefit to each side, being able to focus on that one specific part of the business. Now, investing in companies after the stock has fallen due to an announced lawsuit is probably the easiest strategy of the 4 here, but by no means easy if you do it right. Rather than just jump into every lawsuit target, you have to have a good reason to believe that that lawsuit is without merit or that the market has overestimated the consequences. Now, one point here is that just because the book presents these 3 strategies separately doesn't mean you can't use them together, really as one inclusive way to find great stocks. You can use that contrarian approach to find stocks beaten down by investors, maybe because of a lawsuit, and then look at the financials to find those deep discount stocks to fair value. Understand that this is just one of the chapters in Benjamin Graham's The Intelligent Investor, so I'd highly recommend picking up a copy to get everything he's talking about. I'll leave a link in the video description below to get the book on Amazon. It's an amazing investing book and really going to help you put these strategies into perspective. We're here Mondays, Wednesdays, and Fridays with the best videos on beating debt, making more money, and making your money work for you. If you've got a question about money, just scroll down and ask it in the comments, and we'll answer it in a future video.